thousands of equity mutual funds in the U.S., so picking a dozen or so to build a portfolio can be a mind-numbing task. Hi, I'm Jason Brown with DAL Investment Company in San Francisco. We've been helping investors pick winning mutual funds for decades, using just 3 simple steps. 1. Group funds by risk, not style. 2. Rank monthly, based on performance. And 3. Replace any low-ranked funds with top-ranked funds. So let's take these steps one at a time. First, group funds by risk, not style. We know markets change, and we want our portfolio to change with market leadership. So let's look at an example of an actual market rotation. Then you can see why this is important. This 12-year chart appears to show that the blue fund, Value-Oriented Fidelity Equity Income 2, outperformed the red fund, Growth-Oriented Vanguard Index 500, throughout the entire period. But in fact, it didn't. There are actually 3 distinct periods here. By isolating them, you'll see how obvious and important they were. The first period, which lasted about 4 years, the value fund actually did twice as well, gaining 126% versus 59% for the growth fund. This was a period where value-oriented funds led growth funds, but leadership reversed for the next 6 years, and growth funds gained twice as much as the value funds. That's 248% in this example versus 132%. More broadly, growth-oriented funds that had previously underperformed beat value funds consistently for this entire 6-year period. Now, the last period favored value funds again, and in our example, the value fund gained 16% versus an 18% loss for the growth fund. Now, this is just one of many market rotations that occur all the time, and not only between value and growth, but this period, for example, was followed by a major trend that pushed foreign funds to the top over U.S.-based funds for the next several years. Market leadership changes continuously. It's easy to see this in hindsight, but to make it work for you, you have to know what's leading now. Then you can take advantage of it. This brings us to step 2, rank funds by performance. And the key is, you have to focus on what's happening now. Long-term performance just won't help. We've been managing money and publishing mutual fund performance for over 40 years. And we've determined that the best ranking periods for selecting funds is actually a combination of trailing 1, 3, 6, and 12-month returns. So let's go back to our 12-year chart of value versus growth. And this time, we added a line on the bottom. It lets us see market leadership more clearly. When this line slopes up, it means the value fund's doing better than the growth fund. And when the line slopes down, growth is doing better. This is called relative strength. As I said earlier, we've actually determined that the best ranking periods for selecting funds is a combination of trailing 1, 3, 6, and 12-month returns. This 12-month window on our chart lets us visualize the ranking periods. You can see that this window is shorter than the long-term trends we want to take advantage of. That's why if we rank funds in this window, we can get in and out of them in time to capture most of the prevailing trend. Of course, it's not enough to rank funds once then walk away. Markets change. A fund that does well in one type of market may not and really should not do well in the next. To stay invested in top funds, we need step 3. We have to sell our losers and buy winners. We call this upgrading. In order to continuously invest in leading funds, we review our fund ranks monthly. It's actually easy, and it takes only a few minutes. When you hold a low-ranked fund, just replace it with a top-ranked fund. Here's a monthly ranking of our core risk group, Class 3, ranked from best to worst from top to bottom. Typically, we buy funds in the top 10% of their risk class. That's the green shaded area. And we hold them till they fall below the top 30%. That's the gold area. Funds we sell are replaced or upgraded to the highest ranked funds we don't already hold. So the 3 steps to ensuring that you only hold winning mutual funds are 1, group by risk, not style. 2, rank monthly by near-term performance. And 3, upgrade by replacing low-ranked funds with top-ranked funds. But does this upgrading really work? Well, this chart shows how our upgrading strategy is compared versus the S&P 500 index for the past 30 years. Had you invested $10,000 in 1980 in the S&P 500, it grew to $220,000. But if you instead followed the 3 simple steps we showed you today, that same $10,000 grew to $800,000. That's nearly 4 times as much. How can you apply these 3 simple steps to your own investment portfolio? We publish the No Load Fund X newsletter, used by thousands of subscribers for over 30 years. Each month in No Load Fund X, we do Step 1 and Step 2 for you. We group the funds by risk and rank them based on near-term performance. We tell you exactly which funds to sell and what to buy. All you have to do is Step 3, and you can start upgrading your portfolio today. If you have questions, would like to see our current recommended portfolio, or if you like the idea of upgrading, but you don't want to monitor and trade your own account, just give us a call or send us an email. For other free reports on fund investing, check out our website. Thank you for watching.